Nobody broke the law. Nobody pulled the fire alarm. And yet, the system collapsed anyway. That's the part we're never taught. We like to imagine financial crashes as crimes, greed, fraud, a few bad actors who went too far. That story is comforting, because it implies crashes are preventable. Just enforce the rules. Just punish the villains. But history keeps telling a colder story. Sometimes, financial systems collapse precisely because everyone followed the rules, and that's what makes this dangerous. Right now, we're told the global financial system is more regulated than ever. Banks are stress-tested. Capital requirements exist. Central banks have playbooks for emergencies. On paper, everything looks controlled. Yet the biggest collapses of the last century didn't happen because rules were ignored. They happened because the rules themselves quietly guaranteed failure. Here's how that works. At the core of modern finance is leverage, borrowed money used to amplify returns. Banks take deposits and lend most of them out. Governments issue bonds and roll over old debt with new debt. Corporations borrow to buy back their own stock. None of this is illegal. It's foundational. The system assumes not everyone will ask for their money back at once. It assumes growth will continue. It assumes tomorrow will be slightly bigger than today. Those assumptions are not written into the law. They're written into the math. Take banks. A healthy bank, by regulation, might keep only a fraction of deposits as actual cash. The rest is invested or loaned. This is called maturity transformation, short-term money funding, long-term promises. Perfectly legal. Highly efficient. Until it isn't. If confidence drops, withdrawals accelerate. The bank isn't insolvent in theory. Its assets exist. They're just locked in time. Mortgages, bonds, loans that can't be sold quickly without losses. So the bank fails, while technically obeying every rule. Zoom out to governments. Modern states don't pay off debt. They refinance it. Old bonds are replaced with new ones. As long as interest rates stay manageable and investors keep believing, the system hums along. Again, legal, normal, encouraged. But here's the uncomfortable math. When debt grows faster than the economy servicing it, stability depends entirely on trust, not productivity, not value creation. Trust. Once trust cracks, yields rise. Refinancing becomes expensive. Budgets strain. A government can follow its own fiscal laws and still spiral into crises. No rule is broken. The floor just gives way. This is why financial collapses often look sudden, even though they're slow-motion events. The system appears stable right up until the moment it isn't. Like a bridge engineered to hold increasing weight until one extra step causes a total failure. The irony is that regulation often amplifies this fragility. Rules push institutions to behave similarly, hold the same safe assets, follow the same risk models, react to the same signals. This creates herd behavior, but with spreadsheets and compliance officers. So when pressure hits, everyone moves at once. That's not chaos. That's coordination. Popular narratives tell us crashes come from irrational panic. In reality, panic is often rational. If you know the system only works as long as everyone else believes, leaving early is logical. The absurd part is that no one inside the system can stop this. Central banks can inject liquidity. Governments can issue guarantees. But these are patches, not cures. They buy time by expanding the same balance sheets that caused the fragility in the first place. More leverage and more promises. More future risk. This isn't a conspiracy. It's a design problem. Financial systems are built for efficiency, not resilience. Efficiency means less slack, tighter margins, and higher interconnectedness. That works beautifully in calm conditions. It fails spectacularly under stress. Think of it like an engine tuned for maximum speed with no spare parts. Incredible performance until something minor breaks. And here's the part that should make you uneasy. Every major reform after a crisis focuses on preventing the last collapse, not the next one. New rules fix old leaks, while the underlying structure remains the same. Debt still compounds. Leverage still accumulates. Trust is still the invisible load-bearing wall. So when the next collapse comes, it won't look like villainy. It will look like procedure. Signed documents, approved models, lawful decisions. The system won't fail because someone cheated. It will fail because it did exactly what it was designed to do. Which leaves an uncomfortable question hanging in the air. If the rules themselves can produce collapse, what does stability actually mean in a system like this? If you want to understand how money really works, not the headlines, subscribe to Credit Clever. No hype. Just the hidden mechanics behind the system.